Hello and welcome. Today we shall be taking a look at Consumer and Personal Healthcare Products Group Cussons plc. The company has a market capital of £757 million and is currently ranked 221st in the FTSE 250 index. In the financial year to June 2018, Cussons had a turnover of £762.6 million and an operating profit before tax of £66.6 million, which gave it a margin of 8.73%. It currently pays an annual dividend yield of 4.57%, which is paid semi-annually in April and October. This dividend is covered 1.62 times by the earnings per share. Cussons Soap was founded in the UK by Cussons family in 1938. PZ was founded in 1884 in Sierra Leone and was listed on the London Stock Exchange in 1953. Cussons was taken over by PZ in 1975. The current CEO, Alex Canellis, joined PZ Cussons in 1993. He was appointed Managing Director of the group's Thailand operations in 1998 and Managing Director of Indonesia in 2001. He joined the board in 2003 as Regional Director of Asia before becoming Chief Executive in June 2006. PZ Cussons employs over 4,500 people worldwide, with factories located in Salford in Manchester, Nigeria, Thailand, Indonesia, Australia, Greece, Kenya and Poland. Operations in international geographies. Africa, which includes Nigeria, Ghana, Kenya, was £275.6 million, which is 36% of the total revenue. Asia is Indonesia, Australia, Thailand, Middle East was £212 million, which represented 28% of revenue. Europe is UK, Poland, Greece and the US, which was £275 million and represented 36% of revenue. PZ Cussons supplies consumer brands, many of which occupy first and second place, leading market share positions in the four main categories. Personal care category includes Saint-Tropez, Sanctuary Spa and Charles Worthington. Food and nutrition, dairy products NUE, Olympic, cooking oils and baby food. Home care category, dish care, Morning Fresh and fabric care Radiant and Duo. Electricals is a joint venture with Haier, selling white goods in Africa only. For the previous 5 years, PZ Cussons has had a consistent revenue of between £762.6 and £861.4 million and an operating profit margin ranging from 8.7% to 14.4%, which gave it an average of 10.8%. The forecast for next year is a 2.1% drop in revenue to around £746.3 million and a margin of 10.6%. With generated earnings for the previous 5 years of between 13.39 pence and 17.96 pence per share, the dividend has always been covered by at least 1.6 times the earnings per share. The share price standard deviation for 2018 was 36, compared to 260 for the FTSE 250. The current share price is 1.8% above the 52-week intraday low. The trading update in March stated that profit for the full year will fall short of expectations, as the UK had experienced lower levels of purchases and significant cost inflation in Nigeria resulted in lower volumes, prices and margins. The trading update in June that first half of the year had been constrained by trading conditions in the UK and trading conditions in Nigeria had tightened further. Results in the group's other markets had remained robust. The final results in July stated revenue down 5.8% and earnings per share down 18.5%. The December update stated Europe and Asia had seen continued good performances as a result of product innovation and distribution expansion. Africa trading remained challenging as a result of the economic situation in Nigeria. In January 2019, the half-year interim results stated a 10.4% fall in revenue and net profit before tax for the full year now expected to be towards £70 million and not the £80 million previously expected. Net debt was now at £177.2 million. Good growth and profitability is seen in Asia and Europe, but in Africa there's weak consumer environment. The wage increases have continued to remain well behind the significant cost inflation over recent years, resulting in subdued consumer disposable income. As higher oil prices have contributed to increased foreign exchange reserves, this could change following the general elections which are scheduled for February 2019. The UK, European and Asian markets appear to be holding up, but with 36% of the company's sales coming from Africa, specifically Nigeria, the balance sheet will be hit. Cussons has strong brands in established markets and long-term growth potential in emerging markets, but it is reliant on Nigeria, which has weak sales, rising costs and severe port disruptions. With 3 profit warnings throughout the year, the share price has fallen. The PER is now 13.5 compared to the FTSE 250 average of 16.2. Cussons pays a dividend yield of 4.57% compared to the FTSE 250 average of 3.18% and is covered 1.62 times by earnings. For these reasons, I have given Cussons at this moment in time an overall rating of 2 out of 5. Thank you for watching. Please leave comments below. And also like and subscribe for further analysis of UK company businesses.